Good evening, partners. Very warm welcome to you. Today is an interesting session. This is Balaji from AssetPlus. And it's going to be a tough job for Mr. Aravindo to handle you all today since the markets has corrected from 60,000 to 53,000 and almost 12% correction has come. And most of the WhatsApp groups have been seeing is all silent. Maybe the Josh is not there since the markets have fallen. One of the few messages which I have read is the SGX Nifty has fallen again, Dow has fallen. Everywhere there is a negative news, and we have seen Fed rate having a hike of 50 basis points and repo being hiked by 40 basis points. And if you all remember that 6 months before we did a call telling that if you have huge investments or huge allocation into small cap and mid cap, please book profit and move into products like debt, do a proper allocation. Incremental money, please bring into SIPs and STPs. Had a call exactly 6 months ago. A couple of other fund houses also had given the similar kind of an so having said all this, today we have an interesting speaker, Mr. Aurobinda Prasad, who is the head of commodities and strategies at Tata Asset Management Private Sector. He has a rich experience of 17 years in the area of financial research, currency and commodity analysis management. And having said all this, he is also a gold medalist in operations research and has completed his MBA Finance from Cochin University. And he is a fund manager of Tata Multi-Asset Fund and Tata Equity Savings Fund, where he can also take us why Tata Equity Savings Fund also will be one of the options for us to look into this product post the end of the call. Over to you, Mr. Aravindo. You can give us the outlook and also take more questions for us on how to travel in this market and what kind of asset allocation that we should all follow.
Okay, thank you, Mr. Balaji, and thank you everyone for joining. I hope it's a bumpy ride that all of us are not enjoying, but I want to quickly talk about a few macro events which is ongoing, and I'm sure everybody digests the macro event and how it has been reacting to the entire world market is something that is very well known. So the kind of market correction that is happening is something that one should have been already expecting and planned the investments accordingly. As Mr. Balaji spoke that 6 months ago, probably they had proposed that one should move out of small cap or mid cap stocks or move into some sort of other investments, like maybe as he was mentioning about debt products, or maybe you can move into hybrid products. So I won't say the fact that do not worry or things will come back to normal states. It might all happen eventually, but current scenario is such that it's actually risk off situation with the US hiking interest rates by 50 basis point, which is known to everyone. Perhaps the ECB is also talking about. It is a known fact how China is performing in terms of facing the lockdown. Almost three-fourths of the country is getting locked down, and demand point of view, if we look at from China, one of the largest consumer of many commodities globally, the consumption have come down, the demand has come down. On the other side, if you look at the Russia-Ukraine war, has not come to any sort of truce. So we have to accept to the fact that the 3-4 events that are going on, they might be prolonged for a while, or maybe let's say a couple of more months. But one thing we all must remember, the repercussion of all these events, these after effect of all these events are going to be there for some time. Russia-Ukraine story, if I would quickly talk about, this has actually disturbed the global supply chain. So be it you talk about crude oil, which is a very hot topic being discussed globally, and the various commodities which Russia and Ukraine exports, like natural gas to the entire Europe, various other commodities that Russia and Ukraine exports to many other countries like us in India, the supply is getting disturbed, and that has led to higher inflation. When higher inflation has happened across the globe, the economic growth rate has probably been hit for a while, and therefore central banks across the globe are concerned that it could be termed as global, if I would not say recession, I would say before recession there is something called stagflation, where inflation is high, economic growth is not good. So it's such kind of situation where economy is not doing well and inflation is so high, it is not coming off so easily, and perhaps it is going to be there for some more months. Then what central banks could do? They have no choice than hiking the interest rates. I'm sure we have seen ECB doing, we have seen Fed doing, India doing, many other countries might come in the pipeline. But one fact that I want to tell here is that the percentage of interest rate that are being hiked recently or probably proposed to be hiked in this year, are they sufficient enough to control the inflation which is going on? Should be a question mark in our mind, because if you read across newspaper today, if you look at the US interest rates close to 1%, if you look at the other developed countries, they are at there. At what percentage of interest rate that it should rise to 2%, 2.5%, 3%, and then the central banks can be able to control the inflation that is going on. So we have to accept to the fact that the kind of interest rate that are being raised now may be probably not sufficient enough. But by just rising the interest rate, things will get normalized, may not be possible always, because the commodities which leads to inflation globally, especially the energy sector part is concerned, which is having directly or indirectly linked to many other sectors in a country or the globally per se. So the commodity prices needs to the energy prices needs to come down. So broadly, all the facts that I'm trying to tell here is that it's all known fact. The interpretation needs to be done slightly differently. Everybody says interest rate is going up. It might go up by another couple of basis points. But is that sufficient or not is something that one has to think. If it is not sufficient, then what happens? We are not going to recover our economic growth so easily. The inflation is not going to come off from the highs that are now easily. If that kind of pessimism, economic growth pessimism or inflation being higher, then probably we have to feel the brunt that we are seeing last couple of months, maybe for another couple of more months also. So all the tightening process being done by these central banks are always a man-made process. Or if you look at the export ban by Russia to many countries, or Europeans not willing to buy oil and gas from this, is actually disrupting the supply chain and becoming a kind of disturbance in the uh, supply chain of the global market. So unless that problem sorts out, please remember, unless that problem sorts out, we are not just going to come out of this issue so soon. That we have to accept to the fact. Now if you read news and look at the updates that's going on, it's more than the Russia Ukraine. It is more of the sanctions that are being imposed on Russia from Europe and US, and who knows tomorrow, a virtual kind of war activity might move in. So I might be sounding very pessimism, and to curtail all these concerns that are there, central banks are really putting their maximum effort. Everybody has their own interpretation to look at it. So my submission here is that, and in on top of that, China problem has just propped up in last 15 days or 1 month time, which is again an unexpected event that is happening. So sometimes I feel commodity prices are so high, leading to global inflation higher. And on a good side, if I look at it, the consumption from China is getting hit because of lockdown. That naturally pulls the commodity prices lower. And that is what exactly we are seeing in the month of April and just 10 days past of May. So at some point in time, you are actually paying the cost by having a lockdown, and because of which commodity prices also have started to soften. So it's like paying, China is paying the cost to make the entire world to come out of the suffering that because of commodity high prices. And with that note, I would also say that because of risk off situation going on, from the investment point of view, if I would say, now every investors globally have become little risk aversion. And because of risk aversion, we are seeing the kind of market that are plunging last couple of weeks now. We are seeing Nifty coming below 16,000 multi-month low. We are seeing global equities falling down. We are seeing US is falling down. We are seeing some of the commodity prices are also started to correct. We are seeing the global yields also have gone to a very substantial number. We are seeing US dollar, the only asset class. We are seeing US dollar, the only asset class which is going up. Now, here is a problem. When US dollar goes up so much, so continuously, the dollar denominated assets that are linked to dollar, like commodities, like global equity markets or currencies, everyone are getting impacted. And it's kind of a I would say trap kind of situation. So we all have to face it for a while. I think things can, which is all seeing very negative at this moment, it will need to get digested by itself for a while, or it might take some time to get it digested. So my submission is that with this kind of situation which is being noticed, where markets are correcting, equity markets are correcting, currencies are depreciating globally against the dollar, commodity prices still maintaining high prices, more or less, if you see, irrespective of the fall that is being noticed in the month of April and now. So, but still, we are all facing these challenges. So, what is the investment strategies that one should really look at? It is so easy to say that get out of equity, move on to debt, but is that really going to be possible by everyone? Look at the industry of mutual fund, look at the industry of alternate investment fund, PMS, uh, direct equity investors. That may not be so easy, or that's not actually the fact that just move out of the equity and move on to the debt side. And the moment you move, actually do this, move out of equity and move on to debt side, so much of supply will actually spoil the returns of debt side as well. So that equation doesn't hold truth. So according to me, one has to get into some sort of hybrid, um, you know, uh, investments where you have various asset classes part of your portfolio. So let some part of your portfolio continues to be equity, but the selection of right equities, um, you know, cap is very important here. Should you really continue to be holding the small cap or mid cap, or should you move your positions to large cap so that you do not get hit so much? That is one way to look at it. Should you be investing into gold silver as part of your asset class, which gives you some sort of comfort to your overall portfolio? Should you also park some sort of investment into the debt side so that you get a balanced portfolio? So what I'm trying to tell you here is that the reality is that markets are correcting. Now we need to be very clear with our selection process of a new portfolio while we are building, or we also need to be very clear from here, if I have to remake my portfolio, what strategy that one should look at it. So this is how one has to look at it. If you have been remaining quiet and invested, I'm sure you are going to experience the way market is going to react. So one notch higher, we have to change our strategies. So this is the reality. I'm sure a couple of months later, when things will surpass. We had seen the year 2020, March, April, where equity markets were making the rock bottom lower prices. And but if you look at the positive side of it, from then the equity market actually surged so much. So if I look at from 2020 till date, the kind of gains that happened, some percentage of gains have been erased now. So staying invested for long term, obviously it makes sense. But being a little bit of active in terms of taking decisions will also play a role. So my outlook point of view, if I would say that the risk off situation is going on, and that is probably going to be held for a while. It is not so easy that the central banks are going to rise the interest rate from 1% to 3% just in next couple of months or weeks. It may not be possible so easily. So this is going to be time consuming. Inflation needs to cool off slowly. Russia Ukraine stories which is going on globally, it has to come to a truce. I hope it all happens very soon and China comes out of its lockdown phase, and hope everybody recovers well, better there. So this is a normal condition which will take its own time to recover. So, so the outlook here is that my personal outlook here is that staying directly invested into equity or direct small cap, large cap stocks or mid cap stocks, one has to move on to hybrid category kind of areas where you need to have multi asset as part of your exposure, where you need to be exposed to some sort of equity, some sort of debt, and some sort of commodities. So that's the view that I would have currently about my thought process looking at the global scenario. Quickly, I'll talk about a little bit on the Tata Mutual Fund schemes. I think I have the advantage of speaking a little bit about our Tata Mutual Fund schemes. I'm sure, especially I'll try focusing on the hybrid part of the schemes, because if you look at our product array of products, we have a very conservative product, something like equity savings schemes. And then if you look at, we have something like multi-asset schemes. And then if you look at, we also have balanced advantage fund, and then we have aggressive hybrid fund. So if you draw a line and then try to build the risk appetite of each of the scheme, then I think if I make it from bottom to top, then equity saving schemes is typically considered as one of the safest one. The combination is pretty simple, like 30 to 35% you do into the equity exposure, 30-35% you do into the debt side, and then you have some 10% exposure on commodities, and of course within equity also your selection of stocks are low beta profile stocks. So that is expected to give us a steady return of 6-7% kind of return, and it is considered to be low risk kind of profile, kind of a scheme that is available for the investor. Now if you go one step higher, you have two products here. One is balanced advantage fund. I'm sure everybody understand it very well. There is something called multi asset fund. The difference here is that in balance advantage fund, typically you try to build your product between equity hedge, and debt. In multi-asset fund, the structure more or less remains same, where you have equities, you have debt, plus you have one more asset class, that is commodities. Okay. So now if I make it from the risk profile point of view, at the bottom it is coming as equity saving schemes. Then you have on a falling kind of a market situation, you have balanced advantage fund, and more slightly higher risk, it is multi-asset fund, and on top of that you have your hybrid equity fund, aggressive hybrid equity fund. So this is the product array that we have, considering the current market scenario which is going on globally today. So one should look at rearranging their portfolio at least to an extent, so that one has to park some of the funds in the either balanced advantage fund, or multi-asset fund, or equity savings fund, are the three ones which I would propose. I'm sure as we turn into the market scenario eventually into a better note, then probably again restructuring of portfolio is something that would be required. Then you have something called hybrid equity fund. Then probably one can look at moving into the large cap stocks or mid cap funds or small cap stocks. So that kind of situation. So these are all more of periodic in nature. Given the risk of situation, my view here is that one has to move on to the hybrid category of the sectors, and areas where one needs to diversify by investing into various portfolios like this. I have tried to give you a broad view about the market. I have tried to give the basic understanding how the asset classes might perform. And especially on the commodities part, I will quickly talk about a bit on the outlook, what I have in my mind. And also one point I try to explain about the array of products that we are offering from Tata Mutual Funds, which suits to various kinds of investors based on their risk profiling. So lastly, I would talk about quick thought on my views. So I'm sure gold is something is being generally accepted in our country by everyone. If I talk from the international point of view, we had seen gold prices making a multi-year high of $2,070, and today, if you look at it, gold has come down, plunged a lot, and it is trading at $1,850. But Indian terms, if I would say, we were at 55,000 rupees for 10 grams. Today, it is below 50,000 rupees for 10 grams. Now, here the question is, one should one be investing into gold at this moment with the so much of price correction that has happened to gold? I would personally say yes, because considering the risk aversion situation, the riskiness of the situation that is going on globally, one should try investing into gold or gold related products or schemes by which you are actually protecting your overall portfolio by in the form of hedging. So I would give a price band of gold typically in domestic terms, if 49,000 to 54,000 is a band that one should look at it. It is very easy acceptable range, because it's a new normal phase that Indians have accepted that gold prices uh, will not probably ever be coming down below 45,000. At 45 to 48,000, one would be very, very vigilant to get into spree buying. And then on the higher side, 55, 56,000 is the upper band for the next couple of years, is something that one should look at it. So since we are below 50,000 now, so one should look at investing gold in whatever forms is available as part of your portfolio to make it more diversified. And another important commodity, crude oil, if I would quickly talk about it here. Crude oil is really talk of the town. We had seen crude oil prices 2 years ago went down below zero. It went actually into the negative prices. And this year, crude oil prices hit a new historical high of 140, $42. And today we are just hovering around $100. So I'm sure rising crude oil is always a pain to everyone in the world. So there is no excuse for anyone. So if you remember, when we had been to crude oil at $140 couple of months ago, then entire world, central banks, politics, there are a lot of pressure built on to pull the oil prices down. So it went down $200. But one thing you must remember, what are the fundamentals talking about crude oil? Can this be ever coming back to $70, $60, $80? At least in my view, for my immediate view for next couple of months, oil prices correcting substantially lower seems a little unlikely, because OPEC is an organization that typically decides the global supply of oil, and they are being very uh, stubborn in terms of rising the production despite such kind of situations globally that is going on. So oil supplies are not going to rise so soon. And in the meanwhile, the bottleneck tightness that is being or I would say the sanctions that are being put is unnecessarily creating a man-made supply crunch that is leading to oil prices higher. So unless these side of problems get sorted out, oil prices will continue to hover on the higher side of the range. Broadly, if I would say, it's like 90 to 120 is kind of a range that one should keep in mind. And also must understand, as long as the oil prices are holding higher prices, it is never good for the economy, and therefore directly or indirectly our globally equity markets are also getting hit because of the economic growth rate might get hit. So that's all I want to say to everyone. If you have any questions, I'll be happy to talk. I'll be happy to answer, but very straight stock specific, I might not be in a position to answer, because my expertise is onto the commodity side and the macro side and currency side. Yeah.
Dear participants, if you have any question, please unmute and you can ask in the call, or you can post it in the chat box also.
Hi, this is Harmit Mankre. You said something about economy of China is holding, this certain things. So can you come out with that again?
What I'm trying to tell you is that China is one of the largest consumer of commodities in the world, be it gold, be it crude oil, be it various agriculture products, be it metals. So China is one of the largest consumer of various commodities globally, and China is also one of the largest producer of few commodities. Now, with the lockdown going on in few major cities in China, major states in China, and the inventory number of each commodities that we keep a track of it, all of sudden the reported inventory numbers have started to rise. Actually, 2 months ago, globally commodity inventories were actually rock bottom trend. Why? Because economies were going well. There was growth. There were manufacturing sector doing well. Every sectors were doing well. So plus the supply was getting hit. Therefore, all these inventories of various commodities were all depleting. With the last 1 month kind of lockdown that we are experiencing in China, the usage of commodities are have actually come down drastically. The reported inventory numbers that we keep a track on various commodities, they have started to build up. That indicates that the real consumption in China is not happening. And by virtue of that, since the supplies are building up in China, consumption is very, very less. This is making few commodities like industrial metals, like let's say aluminum, copper, steel, coking coal, and to an extent, to a bit to the oil, demand from China oil is it is making some of the commodities to come down. So my point was then, Mr. Harmit, was that Chinese economic hit because of lockdown also has an impact to the global market. Unless they revive themselves, this will also be an impact to the entire world market, and it is going to impact the supply chain uh, ecosystem of commodities. That's what I meant.
Sorry. So if I'm not understanding it wrong, because the consumption of commodities is lowered due to lockdown in China, the commodity prices has to go down, right? Barring
Yes.
certain commodities. I'm not talking about all the commodities. But then in that case, even if I see and whenever I go to and talk to my customers, they say that commodity prices, very basic commodities like copper or a steel or a like plastic grains and everything is getting price rise of more than I would say 100% certain in certain cases, right?
Yeah.
So
Huh. Yeah.
now how this would impact, because see already there was a supply disruption, and if the China gets opened, right, then this situation worsen, or it would, I'm not getting that,
Yeah.
because
Let me tell you point to point.
ಲೋನ್ ಕಾಡುವಾಗ ಭಾರಿ ಇಂಟ್ರೆಸ್ಟ್ ಅದ ಅವೇ ಲೋನ್ ಕಾಡು ತುವೆ ಲೋನ್ ಕಾಂಡು ತುವೆ ಮಾಡ್ಬೋದು ಅವನ್ ಬರೀ
Just 1 minute, I'll try to
ಅಂತ
answer.
ಕಾಲ ಉಂಟು ದಾಂಡ ವಿಷಯ ಪುಲಿದಾಗ
Yeah, please go ahead.
Yeah, let me try to further answer to your question, Mr. Hamid. On a point to point, broadly, if you see commodity prices, irrespective the fall that has witnessed in the month of April and this 10 days of May, has actually erased around 15 to 20% of the gain that has happened in last 1 year, or let's say last 6 months. In 6 months, actually various commodities have become doubled. You take an example of crude oil, it was 80, it went to 140, and now it is at 100. You talk about industrial metal like copper, aluminum, or lead, zinc, nickel, any commodity you look at it, they all surged over 50%. From 50%, prices have come down by 15 to 20% in last 2 months. But if I make a comparison in last 6-7 months or 1 year, commodity prices are definitely at a higher price, which in the last 10 years we had never experienced. So when you speak to your customer, commodity prices are still higher. Yes, that's the fact, because when I compare today's price of commodity, some of the commodities are still higher before 1 year or before 2 years. So this is why the misleading is, I won't say misleading. This is how the general perception that commodity prices are still higher. What I'm trying to tell here is that because of Chinese concerns, the consumption from China has come down in last 1 month. That has led some of the commodities prices to cool off from the recent excessive gains that we have noticed. That is what I'm trying to explain here. Second, if let's say if China turns out to be again on a normal condition, and assuming the other stories do not change, let's say supply side problems do not improve, and China starts to consume, then it is going to be very difficult situation for global central banks to curtail the inflation, because it is going to be a prolonging effect for many months and quarters, which we cannot uh, control so easily. That is what I try to explain, that it at China is probably paying the cost, so that the entire world is experiencing some sort of softness in few commodities. Like if you look at yesterday, the US CPI number, the consumer inflation number data was released. It was slightly better than the previous month's inflation number, which was at a peak. Now that slightly better has happened because of what? The oil prices have come down a bit, various other commodity prices have come down in the month of April, and that has reflected on the inflation number which was released in the month of April, which got released yesterday. So what I'm trying to say, any softness in commodities today that we are seeing, it is not just because of central banks rising the interest rates, it is also because of China getting hit in terms of its consumptions. That is what I'm trying to explain. I hope, Harmit,
Yeah.
I tried explaining to you.
Yes, yes, I got the exact answer what I wanted. Thanks.
Yes.
Yeah, Mr. Aravindo, if I can ask a question. My name is George, and this is related to, there's a concern which some of the media has already reported, that Europe is getting into recession, probably UK is getting into recession, and there's a view that US also will follow that path. What's your take on this recession talks, which is coming and going, more frequently now?
I think if you go back to the basic studies, before the recession, there is a phase called stagflation. We are experiencing it. It's like growth, inflation, then stagflation, and then moves on to recession. What the central banks is trying to control now or manage is now cut down the inflation, so that the current growth trend is at least managed to maintain. If we do not control, inflation will go up, economic growth will, whatever lower side it is today, it might fall further, and then we will move on to. So typically one step before the recession we are standing today, which is called stagflation. So therefore, the central banks are trying to manage to bring out that stagflation to a normalcy, so that we don't fall into recession, is something that I have an understanding. So now, now it is country specific uh, resultant that you will talk about it. Like if you talk about in India, our growth rate has been steady, but inflation have just started to move up in last 3-4 months. So probably if our growth rate is steady and inflation is higher, we wouldn't term it as a straight away India is at a stagflation. But if we make a comparison, the same story with, let's say today, in some of the countries in the European Unions or UK, their economic growth wasn't good. Plus inflation went up. Therefore, they are already at a in stagflation. Now, if economic growth started to further decline and inflation doesn't get improved, they may be the ones we first called as moving into a recessionary phase. If few developed countries move on to that, the after effect is going to be felt by the other countries, and eventually we will call ourselves that the entire world is facing the recession. So my point is, to answer your point, Mr. George, it is again country specific, but the effect is going to be felt by everyone globally. But before the recession, we are at a phase where the entire central banks are actually taking an effort, trying to give support to the economy so that we don't get into that phase. But if trust me, if it all maintains for next 2-3 months, you have no choice than calling ourselves that we are into a recessionary phase.
Perfect.
So
Yeah,
it is a
thank
tricky
you.
kind of situation, I feel,
Yeah,
Mr. George.
yeah, understood.
Sir, Abhijit here.
Yeah, partners, please unmute yourself and you can ask for questions.
I have a question. How will this Ukraine and Russia war, if it ends, help the markets globally?
First of all, we should wish that that war gets over. But one way to look at it, let's say they will reach to a truce. Russia has reached to a level, it has become kind of stubborn. With so much of sanctions, there is reverse sanctions. To me, it sounds like in Hindi we call it a ziddi. I mean, you become stubborn. So let's say they will reach to a truce. But the equilibrium is not going to come back to normalcy so soon. Like, let's say, they will say the war is over, but our value chain is not going to, our supply chain is not going to come back to normal stage very easily. Take an example of Ukraine. Ukraine does lot of oil seeds production in the world, and they do max 90% of their exports to various countries, whereas India and China are the two largest importer of oil seeds from Ukraine. Now, with this war that happened, or the military war that happened, they have actually devastated many farmlands in the Ukraine region, and they are, at least in this season, they would not be in a position to increase their productivity of agriculture commodities. I have read reports that this year, Ukraine acreage of agriculture lands is only 30% of last year. Why am I going so deep into that? What I'm trying to tell you is that even if the war gets to an end, the effect that is already hit, it will take its own sweet time to recover. So since I took an example of oil seeds, even if the war ends, Ukraine is not just going to ramp up their production of oil seeds from 30% to 150%. That is not possible in one season, perhaps not possible in 2 seasons. So that means the relationship of export import between Ukraine to China or Ukraine to India in terms of oil seeds is already impacted for next 2 years. So as even if the war gets end and the exports of uh, oil and gas to Europe becomes country specific. Let's say Russia says that we will sell it to this country, we will not sell it to that country. Then the ecosystem is also not coming into normal situation. So what I'm trying to answer, Mr. Abhis, is that uh, all of us wish to see the war getting an end. Of course, as an investor, people will jump in and invest into market so much that even if the economy might not grow, with that anticipation, the global stock markets or commodity prices, or let's say any asset classes, will try to recover very faster. That is definitely going to happen. That is definitely going to happen. But what I'm trying to tell you in detail is that the value chain is going to take its own time to come into a normalcy stage. But war ends, people will jump into invest into various stocks, various commodities, various currencies, because everybody will not look at how it is going to shape up. It is just a value bargain buying jump is going to happen. Otherwise, if you see in 2020, March, April, we saw the bottom, and during COVID time only the entire financial asset classes went up very robustly, which probably we had never seen in such unusual situation. So that is the tendency of human investors. So that is going to happen. It's not that Indians also can do that. The whole world does it, and that's how the reactions are. So the point here to answer your question, Abhijit, is that if the war gets to an end, we will quickly see quick rebounding in the various asset classes. That is definitely possible, but that may be a
That will,
temporary phenomena. But
orders will not change.
real growth will happen as and when economy come back to normalcy, which might take its own time.
Just like most of the portfolios have taken a good beating in the last couple of months. So what would you suggest, whether to go into equities right now in a staggered manner, and how to go about it, like in large caps or mid caps or small caps, or wait for some time and then plunge in the market, or go in a SIP mode? What will you suggest?
Frankly, Vivek, this is a little tricky, and I need to be little diplomatic here in answering, but I will give you my honest advice. Staying away from market is not going to make sense. That is number one. Fully invested into equity in whichever form is not advisable. Diversification is advisable. As I said in between my discussion, that you have to keep rotating your portfolio. It's time that my strong advice is to move on to hybrid category. To me, it's not that I'm the fund manager of these funds, but to me, Balance Advantage Fund is a classic product in this kind of situation. If any of the fund houses who increases their equity hedge portion more, and then they act very fast in moving from hedge to equity long to hedge, that is one product. Balance Advantage Fund of ours or anyone's, if you per se, if you see, is lucrative. Multi-asset fund, as I said, is also as lucrative as BAF, because you have commodities like gold, silver, various other commodities being invested along with equity and debt. The beauty here in the multi-asset part is that your debt exposure is only 10% of the fund, up to 25 to 30% exposure in commodities. And commodity, instead of going long in the fund, it tries to deploy more in the commodity arbitrage fund. On an average, the commodity arbitrage is giving 7.5 to 8% exposure return in the fund. So just to quickly think, let's say in the Balance Advantage Fund, you go up to 60 to 80% exposure, 65 to 80% in equity long when situation is good. In multi-asset, you go up to 65%. In Balance Advantage Fund, you have debt exposure up to 35%. Whereas in multi-asset, you have 25% commodities in the form of arbitrage and 10% only in the form of debt. So in the current situation, when equity markets are falling, I'm sure most of the equity fund managers are adopting equity plus hedging activity in the equity segment. In the multi-asset, the beauty here is that your 25% of commodities investing predominantly into arbitrage at the rate of 7.5 to 8%, and 10% it is investing into debt. So if you look at 100%, your 35% of the fund is still immune to the current volatility of the market. And this 65%, if it is more largely invested into large cap stocks plus a provisions of doing equity hedging, then you are actually to an extent and not getting much hit with the current downside movement of the equity market. So my propose to you would be is that rather staying completely away, SIP is definitely a good approach, which is a conventional approach. I would not deny to that. I would strongly suggest get into some sort of conservative to mid risk kind of hybrid products, wherein I feel equity saving schemes, multi-asset fund, and balanced advantage fund are the three funds that one should really have. And one more thing I want to tell you last is that at any point in time, if you are not doing a lot of churn in your fund or in your portfolio, at any point in time, if you have some sort of hybrid fund in your portfolio, it actually makes sense. Is something that I feel. And also it matters the age category your investor is. If you, I'm sure you all know that you are the financial advisors and experts. So depending on your investors profiling, if someone is above 40 plus, having a good exposure in the hybrid category makes really sense to be in the market, enjoy the volatility, plus do not get hit majorly on your capital. So these are the three products which I tried explaining. I would still suggest that one should look at it. Plus, plain gold based investment should also be part of the fund portfolio. Yes.
Thank you, Aurobindo. And to add to it, there have been certain defensive sectors in the market previously when financials were falling. So IT and pharma were considered to be defensive. So any sort of shelter in the market where we can park funds?
No, I can't comment because it will get unnecessarily a contradictory view, because we all I really can't rather I won't prefer to comment much on that, because as you rightly said, at times IT and pharma did very well. In fact, they are still better. It has just that overall markets have come down, so these sectors also have come down. But you have to look at various valuation, you have to look at various sectoral changes, shift in the exposure. But I don't think I am the right person to answer this to you, Vivek. I think you should get connected to our equity CIO, because, or the respective fund manager, because I might look little biased while I'm answering this, so I wouldn't answer this. No.
Thank you so much.
So participants, we have a very few minutes more with the fund manager. So one question that is there in the chat is, Aurobindo, with equity under pressure, high inflation giving debt jitters, do you think arbitrage as an option for short term, and how is the spread on this?
Did I understand we are talking about equity arbitrage?
Yeah, equity arbitrage.
I think our fund has been the best in the industry last 2 years, and the design of the fund is such that 3.75 to 4.5% is the return that one should expect by investing into equity arbitrage, and enjoy the taxation of equity. If a very risk aversion investors or a corporate investing or institutions investing into it, it is definitely a good avenue to invest. But as you know, the risk and the return profile of this category, so it is never a bad idea. But the way the current yields are rising, the liquid fund itself is giving a return of 4+%, and so it is depending on the investor's requirement. If he has got a lot of funds and wants to park it for a quick time and to get the benefit of equity, then it is good to have equity arbitrage fund. But I want to quickly touch upon again, as I said, commodity do have arbitrage trades, which is part of our multi-asset. I might sound that I'm proposing a lot on my fund, but that is a fact that commodity arbitrage is way ahead, almost 200 to 300 basis point higher in terms of returns than the equity arbitrage trade. But and by having so, if you have commodity arbitrage, which also carries no risk like your equity arbitrage, but your returns is far ahead of equity arbitrage. So if you have a multi-asset, then you can actually think of parking it there. But equally, it also carries that equity exposure as well. But to answer straight to the question, having arbitrage as an option for short term, my answer is yes. As far as spread, I answered that is between 3.75 to 4.5%. But if someone is looking at short term, should look at the debt side of the market as well, considering today's yield structure.
So in the call, you were mentioning about the first product is equity savings fund at 30% equity from their BAF fund, from their multi-asset fund. So what kind of investors do you look at investing into equities? And somewhere you also told that someone can expect 7 to 8%. So what is the duration of the trade? Is it for 1 year or 2 years? Or someone is looking to invest into a debt fund, can they look simultaneously to make that alpha to create in terms of returns in equity savings fund?
I would agree to your point, Mr. Balaji. I would strongly agree to that. If I talk about our fund, we have recently restructured it. So we have removed high beta risk stocks from the portfolio. We have done a designing of our portfolio. The debt portion of the fund is also adding good return to the fund. Recently, we also have enabled commodity arbitrage in the fund by up to 10%. So plain vanilla debt investment vis-a-vis equity savings fund with a very minimal risk that is associated on the equity side by up to 30% of the fund. If one is able to digest that and expect alpha over 1.5 to 2%, then I would say equity saving schemes is much better than the debt instruments currently. So, but again, I'm saying to gather that 1.5 to 2% alpha, you are actually taking the risk of 30% on the equity side. But I think it gets adjusted if selection of stocks with low beta risk and very well managed, then I would say ESS is better than debt at any point in time.
Plus added to that equity taxation is there.
Yes, I missed to say that.
And we have one more question is that Tata Balanced Advantage Fund was leading well on peer performance for last few years. However, last 3 months, it has underperformed. Could you just throw some light on it? Maybe because of the equity level coming down or...
1 second, I'm reading. Can you also throw more light on gold versus silver? Okay, there are many questions.
The first question, it is in the first
question.
Yeah.
Okay. Was leading well on peer performance for last few years. And okay, let me clarify. This fund of us of Tata Balance Advantage Fund has completed 3 years. Multi-asset has completed 2 years. Santosh, if I'm right, Tata Balance Advantage Fund is more than 3 years now.
Yes, you are right, sir.
Yeah, more than 3 years now. We have been doing good for sure as far as someone who's saying that we are leading. For last 3 months it has underperformed. But I'm afraid that we still continues to be between 1 to 3 quartile, meaning that we have not been underperforming below 10th number of numbers in the industry. I feel so. But I'm actually do not have the right answer straight away to answer, but I want to tell you something very interesting because this question doesn't seem very correct to me. Sorry. Okay. I'll tell you why. October onwards, 2021 October onwards, equity markets maintained the movement. They did not rise much. October, November, December. January, it started to decline. February, it fell. March fell, and April fell, and now May fell. So if I make our comparison of Balanced Advantage Fund vis-a-vis the industry, our equity exposure was actually at average of 55 to 57%, whereas hedge equity portion was around 10 to 12%. But if I look at the others, the major ones in the industry, their equity exposure was straight away long more than 70%. So I'm afraid since October till now, October, November, December, or let's say until March, 6 to 7 months, we wouldn't have been badly hit or underperforming the others. Rather, I would say our performance would have been decent because our equity exposure was less. Plus, we did around 10 to 12% exposure in the hedging side, which would have definitely given value addition with the current market fall. So since I do not have the peer performance number right now, I would defend myself saying that we have not been so badly underperformed in last 3 months. But Santosh, if you have the number you want to add up a minute here, I would be happy to say, but I have a doubt myself.
Yeah, right, sir. As you said rightly, the top performing fund, they have a equity exposure. In the last 1 month, if you see that the drop which they have is almost 12% to 15%. Our drop is almost 4-5%. That means our 1 year performance, I wanted to take it here. 8.98 is the today's thing, 1 year performance. It was much earlier, it's about 10%. 10% it dropped to 8% 1 month before, if you take it exactly. Or last month you can take it. So the equity exposure, we have it still at 44% in the long, and rest of the things in the equity arbitrage. As you said, other things have been dropped. It's equal to the equity schemes, and our schemes have been very conservatively hit in the market, actually, sir. Balanced advantage.
Santosh, after this call, you can share us the performance. So I'll send it
Yeah,
to
yeah,
the respective
sure.
partner. They can have a look on it. So we
Sure.
have
And
last few minutes. Dear participants, if there is any other Q&A, the questions, you can just unmute yourself and ask.
Yeah, I'm seeing my investment horizon is 10 years, and should I worry about all these things? Can I stay invested in large cap?
10 years investment, I'm sure it's just not lump sum. I'm sure you must be having SIP into it, correct? Okay, I don't know whether it is SIP or lump sum, but I think 10 years CAGR in any form of mutual fund scheme should give you bare minimum of 10% is something that I feel or have been experienced, or the historical CAGR number says that. So if the question is if I should be really concerned about the current market scenario with the market falling so much, I think if you have a horizon of so much, you should not be really worried about it. It is a very straight answer.
Fine. So we have come to the end of the session. So one question from my side, Aurobinda, is that so 2020 between the Jan to April, it was very difficult to go and do sales because offline was shut, COVID was there, everything was there, and it was difficult. And in between 2020 September, October, November, December, we saw all-time mutual funds schemes getting sold very high. So currently in last 10 days, I'm able to see that there is very few sales which is happening, but cutting a large check is becoming a difficult. So someone who needs to cut 10 lakhs or 50 lakhs or 1 crore, it's getting difficult. So how do we convince the client and what should we propose right now? As you have told, equity savings fund is one option, but could you guide us that what should we do at this kind of a market?
And one more, to add to that, one more question. What would be the right strategy to pitch to a senior citizen? The current scenario.
Great.
Okay. It is a difficult question, actually. I'm just thinking that it is not theoretical. The fact is that inflation really hit everyone, the whole world. For us in India, I myself also feeling the hit when I put petrol of 121 rupees in Mumbai. So it is hitting. 2 years ago, the entire 2 years we did not drive much, and at that time the price was 75-80 rupees. And when you come back to in the morning 2 years later, and then you pay at 1 rupees, so it is expensive. Inflation is definitely hitting. In 2 years, people have become a little more smart in terms of understanding investments, is something that I feel. Globally, if you read the statistics, the IT industry, the financial services industry, or various other industries, work from home has given the opportunity of investing and learning investments online, various means. So people have become smart. So it was like, as you said, money was flowing by its own, although you were working from home, but people were still cutting checks. People have become a little cautious by now. It is the change of psychology is something that I could feel. But bargain buying is a place that one has to pitch that market is correcting so much, for long-term perspective, one should remain invested or should start investing, is something that is, I feel that you should pitch. And I don't know, my answer could be convincing or not, is something that is very subjective, I can think. Equity saving schemes, you should pitch to investors saying that take a low risk profile by exposing yourself into equity, so that even if tomorrow market starts reviving, with the hope that next 3, 4, 6 months, you are still sailing the boat and not completely away from the equity side. Plus, equity savings is also experiencing your debt investments plus commodity arbitrage. So why not investing? Equity saving is something that one should look at it. I feel this is how one should propose. I mean, I have a very vague answer to make. Another question is even more challenging. What should you propose to senior citizens people? But definitely fixed deposit is not that one should look at it. Even if you propose for a 10-year bond also for senior citizen people, the probability becomes very difficult. Debt instruments can definitely be proposed, and equity arbitrage fund is definitely can be proposed with absolutely no risk that you typically say, but they have to accept to the fact that it's 4.5%. These funds can be invested. Equity savings funds also can be invested, because today's senior citizen people are also smart enough to understand the dynamics of our world economy, Indian economy. So that sort of risk can be managed to take. So I think my submission will be invest into equity arbitrage, invest into equity saving schemes, and very selective debt products, fixed income products. You're obviously not required to say that you should get into equity investing and all, so I wouldn't say them. And it is definitely an art how you actually talk to this sort of clients, because every senior citizenship need not be risk aversion. Some at 60s also might like to take a risk also. So we have to explain to them the right fact and then probably propose a product.
Yeah, I agree, sir. Thanks a lot.
Yeah, Vijit, I understand that it is straight away not a very objective oriented answer, but I have no choice.
So thank you, Aurobindo. It was a nice time last 1 hour and very informative understanding the markets from a global and Indian perspective. So we can take one last question, Aurobindo, if you have time.
Yeah, sure.
Yeah, dear participants, if anyone is willing to ask question, we can have one more participant. One last question we can have.
So hi, this is Harmit this side again. So my question is on the debt side. So basically, this is somewhat related to the last most question about senior citizens, right? Now the current situation is such that the equities are falling day by day, right? So it is not getting that confidence in the minds of investors. On the other side, the debt portion is also getting expensive because of the interest rate hike. There is a market. If somebody has a debt, he has seen some kind of a fall in their debt portfolio, which is considered well safe for those who are looking for a moderate kind of returns. Now, in a such a scenario, how would one should suggest for the portfolios which they already hold? Somebody must have invested in, starting from October, November, December, where they have not even completed a 1 year, 6, 8 months. They have passed through, and suddenly have seen a what should be, what kind of explanation can be given to them, and what kind of guidance should be given.
Yeah, I'm sure those who have first time investor or those who have started to invest in the month of September, October, their experience is definitely not good, because they may not be enjoying the movement now for sure. It is a challenging task at your end. I can understand that definitely. I think adding up to a little bit on the capital if subject to the investor has the potential, should give them value addition rather guiding them, switching funds and move from here to there. It could be sometimes misleading to them, because you have to give that confidence, plus ensure that they do rupee cost averaging by adding. Let's say someone is doing SIP. It might sound little easy for us to explain to them, but someone who would have done lump sum, so I would say at least 30 to 40% of their lump sum should be reinvested, or if that is not possible, they should get into SIP. And that's how retaining the customer at this juncture, who is a new customer and experiencing negativism, is very important thing, because that is how we achieve our the in the industry level AUM also, right? I mean, that is very important. People should not come out of it and stay invested to experience the good side of the market maybe another 6 months later.
Thanks, Aurobinda. So we will conclude the session. Thanks for your time, and thank you, partners, for joining. We'll meet up with next session again. Thank you.
Thank you, everyone.